Welcome back to the show, everyone. Today we're going to be doing a deep dive into high-yield dividend stocks.
Sounds good.
We've got Pfizer and Altria Group both offering some pretty tempting yields, higher than their industry averages.
Yeah, definitely enticing, but
But are they a sign of hidden value, or are we looking at some potential warning signs here?
that's the big question, isn't it? We got to figure out if these high yields are a real opportunity or maybe a bit of a trap for investors.
Right, exactly.
Yeah.
So let's start with the basics for anyone who's maybe new to this world.
Sure.
Why would someone who's really focused on that income, be interested in these high-yield dividend stocks?
Well, think of it like this. You get a little bonus just for owning a piece of a company.
Okay.
That's what a dividend is. It's a portion of their profits paid out to shareholders, usually every quarter.
Okay.
So with high yield stocks, you're getting a bigger bonus, so to speak.
Right.
And that can be super appealing, especially if you're looking for a consistent stream of passive income.
Makes sense, especially like you said, for people in retirement maybe.
Exactly.
But I know there's always another side to these things. High yields aren't always a good thing.
Sometimes a high yield can actually be a red flag.
Uh-oh.
Yeah, the market might be worried about the company's future. So the stock price gets pushed down, which kind of artificially inflates that yield.
So it's not as good as it looks on the surface.
Right. It's like a big warning sign saying, hey, be careful here.
Okay, good analogy. So
Yeah.
let's jump into our first contender, Pfizer.
Yeah.
They're offering a 6.53% dividend yield, which is quite a bit higher than average for big pharmaceutical companies.
Yeah. And to add to that, their stock is currently trading at a pretty low 9 times its forward earnings.
Forward earnings meaning?
Well, just what analysts are predicting the company will make in the future.
Got it.
So a low price to earnings ratio or PE ratio, as it's called, that can sometimes mean that the market isn't valuing the company properly.
Interesting. So we've got this attractive yield and maybe an undervalued stock.
It seems promising, right?
Yeah, but then I see their payout ratio, and it's a little alarming. 221%. What does that even mean?
Okay, so a payout ratio that high means that Pfizer is paying out more in dividends than they're actually earning.
Oh, so they're spending more than they're making.
Basically, and that's not really sustainable, is it?
Not in the long run? No.
Good.
But hold on a sec. They just announced their 345th consecutive quarterly dividend increase.
Wow.
That's almost 86 years of straight dividend growth.
Yeah, they definitely seem confident about keeping those dividends coming.
So maybe that payout ratio isn't as big of a deal as I thought.
Well, it definitely shows commitment to their shareholders. Their CEO, Albert Bourla, even said this latest increase reflects their strong financial performance.
Okay, so they say they're doing well, but we got to look at the bigger picture here, right?
Absolutely.
What else is going on with Pfizer beyond these dividend numbers?
Well, they're going through a pretty big transition right now.
Okay.
All that revenue they were getting from the COVID-19 vaccines and treatments, it's obviously declining.
Yeah, as things are calming down.
Exactly. So that puts pressure on their earnings and makes you wonder, can they make up for that lost revenue with new products?
So their amazing dividend history might be a little misleading them.
Not necessarily. They do have a really strong pipeline of potential blockbuster drugs.
Right, really.
Especially coming up in 2025, they've got this obesity drug, danuglipron, and several oncology programs that are looking very promising.
Interesting.
So those could definitely drive revenue growth in the future.
So it's kind of a waiting game with Pfizer. We need to see if these new drugs deliver.
Exactly. Can they fill the gap left by the declining COVID-19 sales?
Okay, and then we have Altria, this tobacco giant, playing a whole different game.
Right.
They're offering even higher dividend yield than Pfizer, 7.58%.
Wow. And their payout ratio is much more manageable at 67.3%.
Okay, that sounds a bit better.
Plus, their stock is trading at a low 10.1 times forward earnings, which hints that it might be undervalued.
So on the surface, it looks pretty good.
Yeah, but we can't ignore the fact that they're in a tough industry.
Right.
The U.S. cigarette market is shrinking every year, down about 6% on average between 2018 and 2023.
Yeah, it's a dying market, some might say.
True, but Altria still has a huge market share in the U.S., over 40%.
Wow.
And they have a lot of pricing power, too.
So even with fewer smokers, they can still make good money.
Exactly, supply and demand, right?
Makes sense. But they're not just sitting back and watching the market shrink, are they?
No, they're not. They're actively trying to branch out and find new growth opportunities.
You mean they're moving to vaping and all that?
Exactly. They're getting into vaping, smokeless tobacco, nicotine pouches, you name it.
Trying to stay relevant.
Yeah. They even spent $2.75 billion to buy NJOI, a vaping company.
Wow, big move. So they're really trying to change their image, huh?
It seems like it appealing to a new generation.
Yeah, maybe break free from that big tobacco label.
Exactly. But it's important to remember cigarettes are still their main source of income.
Right.
Projections show that by 2028, cigarettes will still make up almost 90% of their revenue.
So they're diversifying, but not abandoning the cigarettes just yet.
Right.
Okay, so we've got Pfizer facing this post-COVID slump and Altria trying to adapt to a shrinking market.
Two very different challenges.
Both offering these tempting yields, but with totally different stories behind them. So which one's the more reliable dividend play?
Yeah, which one is the real deal? Well, we'll have to discuss that in part 2 of our deep dive. Well, before we make our final call, I'm curious what's standing out to you so far.
Yeah, we've thrown a lot of numbers at you, all those dividend yields and payout ratios and, all the market trends. What's caught your attention?
Yeah, what are you leaning towards?
Right. And keep in mind, what we've talked about is really just the beginning. There's so much more to consider when you're thinking about investing in these companies.
Absolutely. It's like we've just scratched the surface.
Right. We've been focusing on the dividend story, but there's a whole bunch of other things that could impact their performance in the future.
Yeah, things like competition regulation, even the overall economy.
For example, we haven't even talked about interest rates. How do those rising rates play into all of this?
That's a great point. When interest rates go up, investors tend to get more careful about dividend stocks, especially the ones with really high yields.
Because they can get a decent return from something safer, like a bond.
Exactly.
Yeah.
So the appeal of those riskier dividend stocks might start to fade.
Makes sense. And speaking of risk, we have to acknowledge that Pfizer and Altria are in very different sectors.
Totally.
I mean, pharmaceuticals, it's all about those long research and development cycles.
Right. Intense competition, patent expirations always looming.
And then you've got Altria facing declining smoking rates, more and more regulations.
And that constant pressure to find new revenue streams.
Exactly. So both companies have those attractive yields, but their businesses are facing very different challenges and opportunities.
No doubt about it.
So which one is the safer bet for dividend investors? Which one do we think is going to provide a smoother ride?
Well, if we're just looking at dividend sustainability, I'd say Altria looks a little more stable right now.
Oh, really? I mean, Pfizer has that incredible track record, almost 100 years of dividend increases.
Yeah, it's impressive, no doubt. But remember, past performance doesn't guarantee future results.
True.
And that high payout ratio for Pfizer, combined with all the uncertainty around their post-COVID transition, it does raise some red flags.
They're really banking on those new products to fill the gap.
Yeah. And there's always a chance those products won't deliver like they're hoping.
So that makes them a riskier bet when it comes to dividends.
It definitely adds a layer of uncertainty. With Altria, even though their main market is shrinking, they seem to have more flexibility.
Yeah, you mentioned their pricing power.
Right. They can adjust prices to offset some of those losses. And their move into those alternative products, that could be a real growth area for them down the line.
So it's not just about the yield right now. It's about whether that yield can keep going long term.
Exactly.
And it sounds like Altria might have the edge there.
That's what the numbers are telling us.
Yeah.
But of course, investing is more than just numbers.
Yeah.
You really need to understand each business and their future prospects and figure out if those prospects match your investment goals and how much risk you're comfortable with.
It's like we've given you the ingredients,
Yeah.
but you're the chef. You decide what you want to make with them.
That's a great analogy. And just like a good chef, you got to keep learning, keep trying new things, and fine-tuning your recipe as you go.
Okay, so we've looked at the numbers, weighed the pros and cons, explored the risks and potential rewards of both Pfizer and Altria.
Yep.
As we wrap up this deep dive, what's the one big takeaway you want to leave our listeners with?
I think the main thing to remember is that those high dividend yields, they can be tempting, but they're not the whole story.
Yeah, it's easy to get caught up in chasing that big payout.
Exactly. You got to look deeper and understand what's really driving those yields.
Right, it's like detective work.
Yeah, you got to gather all the clues, financials, industry trends, the company's strategy, and put it all together to get the full picture.
And that's what we've tried to do today with Pfizer and Altria. We've shown you their strengths and their weaknesses, their risks and their potential.
But ultimately, the decision is yours.
Exactly. Only you can decide if one of these companies, or maybe neither of them, is right for your investment goals and your risk tolerance.
Right. Maybe you were thinking Pfizer's pipeline and their dedication to dividend growth are going to outweigh the risks of this transition they're going through.
Or maybe you're more interested in Altria's market dominance and their move into those new products.
Or, hey, maybe you've decided that neither one is a good fit for you right now, and that's totally okay, too.
Exactly. There's no right or wrong answer here. The important thing is to find investments that you understand and believe in, investments that align with your own financial goals.
And never stop learning. Keep asking questions and keep challenging your own assumptions.
That's how you become a better investor.
Absolutely.
Well, that brings us to the end of our deep dive into high-yield dividend stocks. We hope you found it helpful.
Yeah, thanks for joining us.
And as always, keep doing your own research and due diligence.
Happy investing, everyone.